I'm Yahoo Finance executive editor Brian Sanson. You're taking a look at a live shot of the opening bells on Wall Street. Yes, we made it. The John and Matthew Goudreau Foundation ringing the bell at the New York Stock Exchange. Viome getting things popping over at the NASDAQ. And you see a little robot there for Viome. I wish I was down at the NASDAQ interviewing that robot. That robot might be coming for all our jobs very, very soon. Fascinating company. Got to look more into that. All right. In wait-and-see mode, investors have had quite a week. On the one hand, getting a hot producer price index, but a tame consumer price index. As it stands, markets are still betting on that September rate cut from the Jerome Powell-led Federal Reserve. There have been a few earnings stumbles in CoreWeave, Applied Materials, and Kava, but a few bright spots from the likes of Cisco. The bullish IPO saw an enthusiastic response, and now markets cast their gaze to the highly anticipated meeting today between President Donald Trump and his Russian counterpart, Vladimir Putin. The outcome of this meeting could have a host of surprises that bulled-up investors haven't even thought about yet. Now, Opening Bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with all that money I know you have in your portfolio. Let's head down to the NASDAQ in Times Square and check in with Yahoo Finance senior reporter Ali Cannell. Ali, I'm just fascinated by that robot that was ringing the bell down there and waving. I mean, a real peek into the future.
Peek into the future, Brian. Who says, finance can't be fun? Friday energy on a Friday. And that's what's happening here today as we continue to look for record highs for the major indexes. In particular, the S&P 500. We are opening in the green today, up about 0.1%. We saw that back-to-back record close yesterday. So if we see any close in the green, that's going to end the week on yet another all-time high. We have the Dow up about 0.6%. Leading the way there is UNH, which I'm going to be talking about in just a second. And NASDAQ opening pretty much flat, just below the flat line at this point. I also have my eye on crude oil, and you were talking about that meeting between President Trump and Vladimir Putin that's set to happen today. We know that oil markets, they're very attuned to what goes on geopolitically. You can just look back a few months ago of the Israel-Iran escalation and what we saw with that spike in oil prices that did weigh on equities. Right now, oil is really at a low here, trading below $63 a barrel when it comes to crude. So all eyes are going to be on that meeting. And then I did mention UNH. We are opening up above 10% today. We're giving up a little bit of those gains, currently up just around 9%. And this comes after Warren Buffett's Berkshire Hathaway purchased 5 million shares of the company at a time when the stock has really been at a low. Prior to this 13F filing, the stock was actually down 50%, nearly 50% since the start of the year. And there have been a lot of compounding issues for UNH, both on the macro side, along with company-specific problems. We had that executive shooting late last year. We also had a cyber attack that happened earlier in the year. But right now, you're seeing shares up about 9%. And a little bit of what we like to call in the biz here, Brian, a deep tease. We will be talking about one company that Warren Buffett is not so bullish on, so stay tuned for that.
Oh, that is a deep tease. Well, look, at the end of the day, who are we to argue with Grampy Buffett? I mean, his track record speaks for itself. Ali, I'll be back in a second with you. All right, I'm kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, tracking Trump and Putin. The markets still have a bias toward taking cues from economic data rather than geopolitical events, but that could be put to the test today. We are keeping a close eye on overseas markets and the oil market as Trump and Putin meet in Alaska later this afternoon. The outcome of this meeting and inevitable chatter on the weekend political shows could set the tone for trading right out of the block on Monday. Number two, earnings, and more earnings. This earnings season has been like rocket fuel for the stock market. The stats tell the upbeat story. 81% of S&P 500 companies have reported positive EPS surprises, according to FactSet. 81% of S&P 500 companies have also reported positive revenue surprises. But earnings season isn't quite over, friends. We'll dive into what we may hear from big retailers next week in Walmart, Target, and Home Depot, and why it all matters. My opening bid roundtable for today, Kenny Polcari in the house, Slatestone Wealth Chief Market Strategist, David Seif, Nomura Chief Economist, and Yahoo Finance Senior Reporter Ali Cannell. Kenny, I want to go over to you here because this is a market that is still inclined to trade on economic data rather than geopolitical events. But this meeting between President Trump and Vladimir Putin, could that change the tone in the market, you think?
Listen, it can change the tone temporarily. Geopolitical stuff can cause chaos, short-term chaos in the markets, because it doesn't really price stocks in the long term. So on a day like today, everybody's going to be paying attention. They want to see how long Trump stays in the room or not in the room, right? He's already made it very clear. If he stays in there less than 5 minutes, there's no deal. He doesn't want to talk about it, and there's going to be more threats and sanctions on Russia. If the meeting goes longer than 5 minutes, then we can all assume that maybe they're making some progress, and that should help to settle things down. So yes, while it's not going to price stocks in the long term, people should be paying attention, although it's not going to hit until 3 o'clock this afternoon just because of the time difference. So the market may not have a lot of time to react.
David, good to see you here this morning, David.
Hey, how are you?
Good. What are the economic ramifications of a meeting like this?
Well, I think that the Russia-Ukraine war, of course, is sort of a travesty from a humanitarian basis. It's not of first-order importance to the United States. And I actually think that if there were to be some sort of a solution, either coming out of this meeting or in the near future, one of the biggest beneficiaries, at least in sort of the developed world, would actually be Europe. Europe has this war on its doorstep. And solving it would unlock a lot of the potential or undo a lot of the hit that occurred in 2022 when the war began. In addition, I think other countries could benefit, such as India, because that would allow them to avoid these the tariffs that Trump has talked about from trading with Russia. And so relief from those could also be a benefit to India in particular, which is one of the main trading partners with Russia that's also been a historic U.S. ally.
Ali, I've been making the argument all week. The market has totally forgotten about geopolitical risks, so focused on corporate earnings, what's happening with interest rates. But look, any bad headline from this meeting will likely dent stocks. Full stop.
Look, Brian, geopolitical risks are always lurking around the corner, and you often don't know when they're going to hit. And I referenced earlier the Israel-Iran escalation, and that really took markets by surprise. We saw that intense spike in oil. We saw equities fall. There was a lot of concern whether we could be heading into a World War III situation. So that's always something that you have to keep in mind. But I totally agree with you. There's just a lot of momentum in stocks right now. There's a lot of risk trading. We are looking at big tech cap companies continuing to outperform. Crypto stocks have surged. And like you were saying, earnings have really been a big driver for that. And across the board, we've seen analysts raise their forecast for the S&P 500, specifically citing earnings. And it's not just earnings expectations for 2025. It's really for 2026 and beyond as well. So that is where the optimism is stemming from, that this rally has legs and that it can also continue to trade higher from here. And I've been speaking to a lot of sources about whether or not we are overbought in this market. And they tell me no, that we're really at a fair value considering where earnings are and how the fundamental story has largely remained intact. Of course, we saw those hotter than expected inflation reports this week. TBD on the impact that will have on the Fed and equities and trade policy moving forward.
Kenny, I originally met you eons ago down the New York Stock Exchange trading floor. So let's pretend we are back there right now. What trades do you put in or put on going into the close, knowing that this meeting with Trump and Putin will happen likely 30 minutes before the market closes?
So I think you have to decide on where you stand, right? I'm more optimistic. I actually think that there's going to be a deal. So if that were the case, then I'm going to go long the market, right? My bets are going to be on the market. If you're on the side of the case that you think there's not going to be a deal and the market's going to back off, then you want to get short the market, or at least maybe you want to get short parts of the market, right? You'd want to go long oil, you'd want to go long gold, if in fact you think that there's not going to be a deal. So it depends on who you are is going to dictate how you set yourself up or how you get ready for what this may be. I'm optimistic. I think there's going to be a deal. I think oil's going to go lower. I think gold's going to go lower, and I think stocks will continue to move higher.
Kenny, you still got it, kid. I knew you. You can't shake that stuff. Dave, let me get back to you because this whole week has been one big plate of confusing economic data. Consumer price index, people got excited about rate cuts. You got the PPI out. That was a little hot. Retail sales this morning, the prior month, June, was revised up. July was okay. Like, what the hell is going on out there? I thought this economic data was supposed to get hit because of tariffs.
Well, you're certainly not seeing that. And it had been our view that we could easily see that this month. I think that was the view of a lot of people. But when you look at the inflation data, yes, it was a little bit hot, but it was certainly not hot due to tariffs. And so when we look back at the past several months, sort of ex tariffs, notwithstanding this month, it actually has been a slowing of inflation. You can put the year-over-year change up there, but you know, if you look just back at sort of where sort of the rolling 3-month average of inflation gone, so zeroing in on more recent history, things had been coming down for a while and only backtracked a little bit this month, for the data that came out this week. And then when we dig into it, the things that caused inflation were really not the things that the Fed has said it was worried about, meaning it really wasn't stuff that was related to tariffs. So when that's all put together, we don't think that the inflation data was hot enough for the Fed to deviate from its SEP, which had, or its a summary of a dot plot, so to speak, which is for a cut in September and then another one in December. And then, today we looked at the retail sales data, and you can see that the consumer is still pretty strong. I think a lot of the reason the consumer is still doing so well, relatively speaking, is that even if there's been some weakening of the labor market, some loss of momentum, you're still really not seeing people being fired. You're not seeing companies lay off. You're seeing companies hire fewer people, but not really lay anyone off. And it's when people are getting laid off that they tend to rapidly slash their spending. With that really not being what's going on right now, it leads the consumer to still be pretty healthy and still probably willing to continue to spend at least a decently robust pace.
David, economists love to characterize economies in letters. W's, U's, Z's, A's, whatever it is. What type of economy does this look like to you?
It looks sort of like a hyphen. So I'm gonna not answer.
I haven't heard that one before. I've been doing this for 20 years. I haven't heard that one before. That's pretty good.
Well, the economy is losing a little bit of momentum. It's slowing. That was something that was happening already when Trump became president this time. And it's really just on the back of the fading of the massive stimulus post-COVID. So that's all gone now. We revert a little bit down to trend, and probably revert a little bit below trend because there is still some impact of the tariffs. But what this isn't, and this is what I really think is most important, this is not a collapse. We don't see a recession or anytime soon. We don't see a spike in the unemployment rate that would be characteristic of a deeper slowdown. So we're sort of muddling along. Certainly doesn't look fantastic right now with the slowdown in job creation, but it looks far from terrible.
Ali, last word to you here. Big week coming up for earnings. Walmart, Target, and even Home Depot. It's these names that are going to put this thesis of, we need a rate cut or we might get one, I think, to the test. If these results come out like garbage and we don't get strong outlooks, none of that's going to be good.
Right, and we've been talking about the state of the consumer, and that really is what all this hinges on. As long as consumers keep spending, if the economy can keep chugging along, that's a good thing. And that really whips back around to the labor side of the equation. We were just talking about how we're not seeing many layoffs at this point, and that's really why we've seen this economy sustain itself at this point. But the results that we get next week, Walmart, obviously a big bellwether when we think about the consumer, and it's not just the results, it's really the commentary on the earnings call. You really have to take all this data in aggregate, not just the eco data, also the earnings commentary, the results. That's really going to give you the best picture of the economy. And when it comes to the consumer, these are the companies that you want to be hearing from. So big earnings week to really round out what's been a pretty chaotic summer, yet we still have stocks at record highs.
All right, Kenny, David, and Ali, hang with me. We got a lot more show coming up. Ed, coming up, Intel may have a new investor, and Salesforce may have a new activist investor. We'll be right back. Welcome back to Opening Bid. When a Wall Street analyst that has been a bear in a stock for a while and then suddenly issues an upgrade, it always catches my attention. Today we have that situation on Salesforce. D.A. Davidson analyst Gil Loria lifted his rating on Salesforce to neutral from underperform. Loria says investor sentiment has declined sharply on Salesforce in recent months as questions mount on the company's acquisition strategy and near-term profit margins. But what may not be factored into the stock is new activist investor activity, says Loria. Loria points out that noted activist investor Starboard, led by Jeff Smith, increased its stake in Salesforce by 47% this quarter, according to new 13F filings. Starboard pushed for big changes at Salesforce just 3 years ago, which ultimately led to a new focus on margin expansion by CEO and co-founder Mark Benioff. Says Loria, we believe this is a signal there will be another round of investor activism and increased pressure on management to refocus on growth of the core business, additional margin expansion, and hold off on dilutive M&A, or mergers and acquisitions. All right, let's fire up my stock of the day. The Trump administration is reportedly in talks with Intel to have the U.S. government take a stake. Intel declined to comment specifically on this to me, but they did say this, quote, Intel is deeply committed to supporting President Trump's efforts to strengthen U.S. technology and manufacturing leadership. The questions here are many, though. One, why would the administration even want a stake in an Intel that is scary behind chief rivals NVIDIA and AMD? President Trump has interacted a lot with NVIDIA CEO Jensen Huang and has gotten a taste as to what it means to be a leader in semiconductors. Two, why would Intel want to get in bed with the government at a time in which CEO Lip-Bu Tan and the board must act quickly to reorganize the company? I find it hard to believe the government will be a quiet minority shareholder. There's a lot at stake here, as Intel is and should be a beacon of U.S. chip making, not the punching bag it has become. The company's financials have taken a major hit, with sales down for more than 3 straight years and earnings evaporating in the process. A lot going on there. Still with me in my roundtable, Kenny Palcari, Slatestone Wealth Chief Market Strategist, David Seif, Nomura Chief Economist, and Yahoo Finance reporter, senior reporter, Ali Cannell. Kenny, I want to go over to you. Any interest in going long in Intel on news like this, even in the keeping in the back of your mind, or maybe you should put in the front of your mind, that this is a fundamentally just wrong company. I mean, nothing's going right for them.
Agreed. So Intel's not a name that I've ever owned, and we don't own it here. But look, it certainly has a pop because of the news. But is the pop temporary? I'm not even sure, and I agree with you. Why would the government want to now be partners with Intel, or why would Intel want to be partners with the government? And what does that say about future opportunities? Is the government now going to start this? Trump going to start to stick his hand?
Kenny, it's like the auto bailout. I mean, it reminds me of when they took a stake in GM, what, 15, 20 years ago?
100%. And so I'm a little bit confused about that. But Intel's not a name that I ever owned at all. I think there's other places to put your money in the space. But so this news does nothing in terms of getting me excited about, oh, I got to jump on this Intel bandwagon. I do not.
David, does it benefit the U.S. economy to have a healthy Intel? Or at this point, the semiconductor industry led by NVIDIA and AMD, and of course a Taiwan semiconductor, they have just passed this company by, and our economy can go chugging along, relying on chips from these 3 companies.
Yeah, I mean, I don't have much to say about individual companies, but certainly the U.S. has a multi-century track record of doing well by sort of not sticking its nose into things and allowing the private market to go where it may. To the extent that Intel has been lagging behind, it may be the best thing for the economy to simply allow it to continue to either wither or sink or swim, so to speak, and allow the current leaders to continue to lead and only lose their lead if they actually get out-competed.
Ali, we're just, about almost 2 weeks away from that NVIDIA earnings report, and it will look starkly different to what Intel put up a few weeks ago. It's night and day. I mean, these companies both might be making computer chips, but they couldn't be more different.
Going to be more different. And Intel, I just feel like it's too late for the company to really catch up to AMD, to NVIDIA. Of course, for the Trump administration, they're viewing this as an issue of national security, that they really want to make sure that Intel can survive through this volatile time. We did have that CEO meeting with President Trump, and really we've seen that across the board of big tech, right? I mean, Apple CEO Tim Cook met with Trump recently, and then out of that meeting was a $100 billion investment in the U.S. So that is President Trump's goal. He wants to bring manufacturing, production, all the things, including all the chip makers, back onto the domestic soil. But they also have other types of agreements that they're rolling out that are very unique and really unprecedented. One of those being that revenue share agreement with NVIDIA and AMD. They're letting them sell some of their chips to China for a kickback for some of the revenue to the federal government. So there's just a lot of moving parts and moving pieces to this. It's still an unconfirmed report. Intel did say that they are looking forward to working with the government, but they didn't confirm whether or not this was actually happening. So it feels like the U.S. is just going to continue to be involved in some of these companies, at least throughout the term of Trump's presidency. What ultimately comes from that and the legacy that leads and how it really changes what we view the chip supply chain as at this current moment, that remains to be seen.
It's time now for my question of the day. On this Friday, Warren Buffett's Berkshire Hathaway sold 20 million shares of Apple during the period according to a new 13F filing. Berkshire's Apple holdings remain its largest equity stake by market value, despite it dropping by about $9.2 billion in the second quarter. So my question is this: if the legendary Warren Buffett is selling tech titan Apple, should you, Kenny?
100% absolutely not. You're not going to make a decision just because you have to look at what he's selling. Where does he own it? Look, when he sold Bank America back when it was trading at 39 and 40, everyone was going, oh my God, he's selling Bank America. I have to get out of my Bank America. Bank America's trading at $48 now. You have to look at where he bought it. He bought it at $5 during the crisis. It hit his price target, so he started to sell it out. That's not necessarily your price target, unless maybe you bought it at $5 as well, and then you decide you want out. But I would not be making a decision to own or not own my Apple based on what Warren Buffett's going to do. Like you said, it is still the biggest piece of his whole portfolio. So I am not selling my Apple.
All right, all right, Kenny, you're clearly fired up on this. Let me follow it on with this one. Have we reached the moment where the average investor should ignore what Warren Buffett is doing?
Well, listen, I think what the average investor has to do is they can't necessarily think that they are the same as Warren Buffett. They shouldn't be planning their life around what Warren Buffett's doing. He's got a very different company. He's been in for a lot longer. Your situation is different from his situation. So, no, I was never in the camp that you're going to build a portfolio around what Berkshire Hathaway is doing. So I was never in that camp. So, no, I don't think you should.
David, on Apple, now, look, they did warn in this current quarter they might see a $1.1 billion hit because of tariffs. How concerned are you about the third quarter tariff impact and what it is going to do, or may already be doing, to the financial statements of corporate America?
Well, I think it's still unclear who exactly is paying the cost of these tariffs. I mean, we could easily be collecting $300-400 billion dollars a year in tariffs, and it's a substantial amount, but it's got to come from somewhere. We're not really seeing it all that much, at least as of yet, in the consumer price index. So consumer might be paying a little bit of it, but certainly not much. So the question is, how much of it is domestic companies and how much of it is foreign companies? And in the case of Apple, yes, it's a domestic company, but since it's producing overseas and then selling it here, if it's not the consumer, then it's got to be Apple in some form. So, and not just Apple, but sort of, companies in general. So certainly it looks as though, given that we're collecting a lot of money and prices haven't gone up that much, this is something where it is going to hit the bottom line of companies in general.
Ali, Kenny brings up a great point. We may think we could pick a stock like Warren Buffett, but at the end of the day, we're not Warren Buffett. We don't have his billions. Maybe Kenny has his billions, but we don't have his billions. We can't move markets like he does, so maybe we should just stop following him.
Right.
Well, look, Warren Buffett is such a loved investor, and people have really looked at Berkshire as a guiding light on how to guide different types of investment strategies. And Warren Buffett, one of his philosophies is buy what you know. What do? We are constantly on this phone every single day. So you are exposed to Apple. You see what it does, the innovation that it brings. Now, the ironic part about all of this is that's why the stock has been struggling. It's because the innovative side, the AI side of the equation, just has lagged a lot of those competitors. But Apple, historically, they're not the innovator, right? Other companies innovate, then they come in and they just build and make a better product. And for Apple, the AI story is going to be more of a consumer story. And I just don't think we're there yet at this point. Right now, it's more focused on chips. It's more focused on B2B. Of course, the large language models, the ChatGPT, that's something that everyday consumers are using more and more. But I think there's still a lot more of the story to come when it comes to AI and how Apple can really utilize that in the future. Right now, it's not there for investors. That's why the stock is down about 7% since the start of the year. But, it's still something that you need to watch, because I do think Apple can maybe surprise in the next year or so.
So, Ali, what you're telling me is I need to go out and buy some Tyson foods because I eat a lot of chicken.
Brian, let me ask you one thing. If people want to play that game and they want to do what Warren does, just go out and buy Berkshire Hathaway, and then you're going to do exactly what Warren does.
My favorite panel of the week. I mean, you guys killed it. Big thank you to my opening bid roundtable, Kenny Placari, David Seif, and Ali Canal. All right, programming note, friends. On Monday, I am dropping a new Opening Bid Unfiltered podcast with special guest Chipotle CEO Scott Boatwright. Scott is making big changes to Chipotle, especially on the tech front. Looking forward to bringing you that special chat. Straight ahead, Julie Hyman has you from Market Catalyst. She'll be talking with Brinker International CEO Kevin Hochman about the sizzling comeback at Chili's, sizzling like those fajitas there. Don't go anywhere.